Lots of good stuff. So to kick the meeting off, I just want to say thank you for one, to Roberta for being our speaker today, to Mindy for all the hard work that she's done putting this program together, and on behalf of the WMBA IP Lunch Committee, which is Tim Merrimee, Eric Seidenberger, Mike Cott, and myself, we just want to thank all of you guys that signed up and are giving up your lunch hour to come and be part of this IP event. Thank you. It's interesting times during COVID, and we appreciate your involvement and help in keeping the flame of the WMBA burning brightly in commercial lending. So we're all here to listen to Roberta Hollinshead, and Tim and I were talking a little earlier. The last time we had a speaker from DFI, it was Rick Riccobono, and we were at the Harbor Club back years ago. And Rick came in to speak about the new and exciting world of marijuana and banking, which had just gone into the division. And so in 2016, Rick retired, and Roberta took over after moving up the chairs at DFI. She was a RAM at West Valley High School in Yakima, so go Rams. Then she went to the UW Foster School of Business and got out of there, and then went and got a Seattle U MBA. So I can say that she's a lot smarter than I am, and I think that this will be good. On a couple of other notes, she was the first woman in Washington history to lead the DFI. So congrats on that. And will be only one of 17 women bank directors in the United States. So I don't know if that number has grown any, but good on you, great work. And her quote is, "My passion for community banking began in my undergraduate studies at the University of Washington. It was then I learned how community banks fuel the economy and support economic growth, often in the communities that need access to financial services the most." So, amen. And I will turn it over to Roberta. And again, thank you so much for being willing to speak with us.
Excellent. Thank you, Steve. Well, good afternoon, everyone. And thanks, Tim and Mindy and the committee for having me here today. I have a whole mishmash of topics I'm going to address, but I'm also happy to answer any pressing questions you may have as we go through the presentation today. I think Steve covered it pretty well. I've been at DFI this summer will be 20 years. So 12 of that I spent examining banks and then overseeing the exam portfolio. And so I certainly, know our industry well and have seen, earned my stripes through the crisis and have seen a lot of evolution in the industry. So I'm happy to answer any questions that you have outside of the prepared remarks I have. So I'm going to go ahead and pop off video and share my screen just to preserve my bandwidth here. As many of you are working at home, understand, I've got lots of coworkers here. I've got 3 kids at home, hoping someday they will go back to school, but I don't know. My hope is kind of diminishing as the days go by here. So Steve, can you still hear me okay? Oh, you're on mute. Okay. That must be yes.
We hear you. Yes, we hear you. Thanks.
Very good. Okay. Thank you. Well, we'll go ahead and get started here today. Maybe if my presentation will advance. There we go. So this is just an overview of the areas I'm going to touch on. And because I haven't spent time with your group specifically, I did want to give just an overall overall industry condition, talk a little bit about what it is that we do in my division of banks. So I'm one of 4 functional divisions at DFI, Division of Banks. I oversee the state chartered banks. We have 38 state chartered banks and the non-depository trust departments here in, or agencies here in the state. So I also have a counterpart over credit unions. I know there's some members of your group here who are with credit unions. And then we have our consumer service division that oversees our non-depository lenders. So, we have a good level of experience with what it is that you all do on day in and day out. And, I'll try to touch on some of those aspects. I'm also going to cover, what our role has been in the rollout of the Paycheck Protection Program. Obviously, that's a SBA program, but I have some summary highlights from the first round, 2020 and 2021. So hoping to speak to that a little bit and the role that many of you played and many of your institutions played in that rollout and continue to play. And then I'll touch on just commercial loan growth in the state, hitting a little bit on obviously the banks and the credit unions. I don't really have good metrics on the non-depository side of things, but hopefully it'll give you a glimpse at what we're seeing. And then I'll circle back to that issue of cannabis banking, the SAFE Act, the MORE Act, and what's going on and sort of what we anticipate may or may not happen in that space. So with that, and as Steve mentioned, I can't see the chat when I'm presenting in Zoom. I don't know why. I'm probably doing something wrong, but please, Steve and Tim, just go ahead and follow that chat, and I will pause, but if there's questions, I'm happy to answer those as we go through. So just to give you an overview of what we do in our division is we conduct what's called the Safety and Soundness exam. Many of you are probably really familiar with this. We assess what we call the CAMELS ratings. So capital, asset quality, management and board oversight, earnings, liquidity, sensitivity to market risk. And what I would say is that overall, what we found a year now into this pandemic and this crisis is that risks remain well managed. And what we really do is a risk assessment. We don't look at consumer compliance laws in this assessment. It's really risk management. How well are the institutions managing risk? What is the risk? Luckily, coming into the crisis, all of our banks were in good shape, in good condition. They had sort of worked their way out of the last financial crisis. Capital levels were robust. They remain robust. The area where we are seeing increasing risk falls into a lot of what you are all doing, which is asset quality. So that's twofold. When we assess asset quality, we're looking at the credit quality, of course, and then we're also looking at risk management. So I'll spend just a little time talking about what we're seeing in asset quality a year now into the pandemic. The good news is asset quality was pretty strong for most of our institutions coming into the pandemic, and that will serve your institutions pretty well. We have seen an increased level of delinquencies and an increased level of adversely classified assets. The banks are doing a really good job monitoring and segmenting those problem credits or the industries that are anticipated to be most severely impacted by this crisis. Overall, we've seen risk management practices are really very good. And another big positive is that in the third quarter, most banks really beefed up their allowance for loan and lease losses. And those allowance levels are pretty robust and quite adequately funded. So what we're anticipating at this stage is that delinquencies will peak next quarter. Of course, we don't have a magic ball, but that's sort of what the industry is alluding to, which is good. It kind of, this whole time we've been operating, you all been operating in this, space of so much uncertainty. Certainly that hasn't gone away, but from a regulatory perspective, we do feel like there's a little bit of light at the end of the tunnel, and we are expecting, those peaks to hit next quarter, assuming, of course, no major shutdowns or changes from sort of the trajectory we're on right now. I just want to give a lot of kudos to the management teams of your institutions, because not only, what we've seen, what we've experienced, and we've continued to do examinations all off-site since the beginning of the pandemic, but what we've seen of management teams is that they've done an incredible job getting their arms wrapped around their current portfolios while taking on the really massive job of deploying PPP loans. As you all know, the technical issues in deploying those loans to businesses were really significant at the beginning. It was a huge lift for your institutions. And so overall, from a credit risk management perspective, we're seeing a lot of positives in our assessment of asset quality 12 months into the pandemic. With regard to board and management oversight, again, we've been really impressed with how quickly the institutions all pivoted to keep their employees and their customers safe. Moving to the drive-up windows and appointment only, pivoting employees to be able to work remotely across the board. And we've seen this across the state, not just speaking to state chartered banks, but certainly banks that are headquartered here and federally chartered banks, those federally chartered banks headquartered here and banks that operate here. Is that they were, what we've seen is a really strong adoption of technology by the financial institutions and consumers. We've seen that pivot really quickly. And so we didn't get, we didn't see any lapse in your ability to provide financial services to your customers, which is a really big positive. In our division and all the divisions, we take in consumer complaints. And generally you would expect with something like this, we'd see an uptick in consumer complaints. And we really have not. I think that's a credit to how quickly the institutions pivoted and your ability to continue to provide services to your communities that you operate in. Earnings, I would say this is sort of our weakest and bleakest area. It was going into the current, situation we're in. Obviously, super low interest rates, margins are compressed. Banking is a business of margins. And so we're continuing to see a lot of strain on the earnings component. And really, I wish it was more optimistic, but, going into the next, 12 to 18 months, we're not anticipating to see, significant increases in interest rates, and that will continue to squeeze those margins. Liquidity, we've seen an inflow of liquidity in the system, ample deposits that stems from stimulus payments to depositors, people being home, not spending as much money. Obviously, we're not traveling, although many of us would like to. So there's a lot of liquidity on the balance sheet of our bank's books. And that in some sense, it's a positive. Those are, generally deposits are considered as the most stable and inexpensive funding source. However, that has to be deployed, obviously, into earning assets. So that does, impact earnings if those can't be deployed into good, solid earning assets. With regard to sensitivity to market risk, this is really just the assessment of interest rate risk in the balance sheet, talked about low interest rates, and the bank's ability for really their earnings and capital to absorb that risk. So we haven't seen too much of an increase in that space. Banks are doing a good job managing that risk and doing their best to maintain those margins given a kind of a difficult situation. So overall, banks are in good condition coming into the crisis. What I think bears repeating, as we've heard over and over again, this was a healthcare crisis, not a financial crisis. Recently, I've heard people referring to this, we had the Great Recession. I've heard people referring to this as the Great Reshuffle. And I think that's really how we're looking at it, is in the sense of those who could really least absorb these impacts are the ones who are feeling it the most. And we've seen some expansion of the wealth gap. Obviously, that's going to have an impact on the industry and your ability to continue to serve, your customers. And we see this across the board, even talking to educators as our kids are doing school from home. We've seen a reshuffling where everybody might be falling behind a little bit, but those kids who didn't have a lot of family support are falling behind even more. And so I think that great reshuffle might stick for what it's worth. On the risk of financial institutions, it's also not one size fits all. Some financial institutions will be more impacted depending on their portfolios, but most, and I would say many, nearly all, now that we're 12 months into this crisis, will come out of this just fine. So before I pivot to talking about PPP and DFI's role in the Washington Recovery Group, are there any questions?
Yes, Roberta, there was a question. You mentioned that the second quarter was going to be the peak of some adversely impacted assets. Do you have any volume numbers or percentage, or what are you seeing that gives you lead to see that?
I do what you all do and follow economists, and follow what our governor's office is saying and what the budgets are saying. And the expectation is that things are going to start improving and opening up. The weather's getting nicer, people are going outside, businesses are getting to more capacity. And so that's really the driving factor. I don't have good metrics to support that. It's more just sort of an expectation, and in my communications with other regulators, I work really closely with our federal counterparts and my sister states here in the Western region. We talk pretty frequently, and that's the general sense from regulators that we're going to see delinquencies sort of peak in that second quarter, and then we'll see some improvement from there forward.
Thank you.
You bet. All right, I'll move into Washington Recovery Group. So the purpose of this group, really I bring this up just to give you a little background, is obviously, DFI has nothing to do with the SBA. This was clearly an SBA and a federal government program. However, we got really involved in the PPP process from the beginning through this Washington Recovery Group. This is an informal group. It was stood up by actually some volunteers, an ex-SBA employee here locally. And it was really to improve communication regarding paycheck, so let me back up, PPP, Paycheck Protection Program loans, and other SBA programs to really increase the communication to businesses. So this group brought together as a public and private sector group. We met weekly, we meet bi-weekly, now we're back to weekly. So we've met through this entire period of time. Includes local SBA officials, the Washington Department of Commerce, our agency, DFI, bank and credit union trade groups, community development associations, those that have the real direct touch to the businesses that need these resources, and then different municipality groups have met. And we've had people jump in from legislators' offices and other offices from time to time. So we've been pretty involved with PPP. I've testified a couple times to the Senate and House just on how PPP is going in our state, the rollout, try to answer questions. And so I'm going to give you a highlight of the Paycheck Protection Program. So this was the 2020. It was actually sort of round one and round two, but we'll just call it the 2020 totals. I won't really go into a lot of detail here, but this is across the nation what was deployed, and then the totals in Washington state. As you can see, our average size of loan was a little bit higher than the national average. And this program ended in August of 2020. This is another slide from the first round. So this was significant because at this time, we were still rolling out how these loans would be forgiven, and there was a lot of pressure on streamlining the forgiveness process for these borrowers. And as you can see here, one of the really, sounding data points in getting a streamlined forgiveness process was that 87% of the loans in the first round were under 150,000. And really the industry was pushing for these loans under 150,000 to get the automatic forgiveness. And as you all may well know, that is what happened with the round two. So this is just a summary of round two. This was passed, actually put into law December 27th of 2020. And this was the second round, what we'll call the second round, the 2021 round of Paycheck Protection Program and other support to small businesses. So an additional $284 billion in funding, loan forgiveness process simplified for borrowers with loans under 150,000. That was huge. The original application for forgiveness was like 17 pages long, asked for a ton of information that these smallest businesses really just, they're not used to putting this kind of information together, made it really cumbersome. So this was a big win for the businesses and the lenders. And really the focus of this second round was to, target those hardest hit small businesses, which were eligible to receive a second PPP loan. A few other aspects of the Emergency Coronavirus Relief Act is that it extended eligibility to additional business types and extended the number of forgivable business expenses. So it didn't change that mix from the first round. In the first round, 60% of the expenses still had to go to payroll and 40% had to go to other expenses. This allowed businesses to add other types of expenses in that 40%. And really it focused some set asides for small loans made by the smallest community lenders. And then it also extended some of the relief that the SBA had been given to existing 504 and 7A loans. They have been paying some principal and interest on existing 7A and 504 loans on those businesses that were impacted by the coronavirus and by those shutdowns. So here's a summary as of last week where we are in the state. And as you can see, well, the state and the nation, as you can see, the average loan size has gone down in the nation. It was 100,000 first round, down to 71,000 in this round. Washington State were a little bit higher at 94,000, but still down from the 116,000 before. And this is just a breakdown of those loans. So the first draw loans, those were the businesses that were able to access this program for the first time. They didn't receive a loan in 2020. As you can see, they make up their average loan size is smaller at 22,000. And the second draw, so those businesses that got money in 2020 and went back and got money in 2021 make up a majority of the dollars. 90% of the dollars are going to those second draws on businesses. I think the message is those businesses, those largely restaurants and other businesses that have been severely impacted, as we all know, they're still impacted, right? So they're going back, they're hoping that this is a stopgap measure to keep their doors open, keep some employees on the payroll, and they're going back to the drawing board. What we have also seen this round, there was a real big push to get some demographic information for who's getting these loans. Legislators all want to have that information. Unfortunately, obviously that information is voluntary, and borrowers and lenders really, it's just not showing up on the form. So there isn't a great breakdown of demographics on this. But the focus has continued to be on these smallest businesses. In fact, on February 23rd, President Biden signed an executive order allowing businesses with under 20 full-time employees exclusive access to the PPP portal. And that ends, I believe, at the end of this week. So for 2 weeks, other businesses won't access the PPP portal. It'll be just set aside for those smallest businesses with under 20 or less headcount, with the intention that these some of these smallest businesses and maybe those that didn't have access before will get access to it. There is an expectation in my communications with the SBA and in talking with some of these community groups is that the majority of businesses who are seeking out this type of funding have done it. And so they do think, even though the program ends at the end of March, they do think there will be funds through the end of the program. So, we'll see if that's the case. We do hope that the dollars are used. That's what they're for. They don't really get deployed in any other meaningful way if they're not used. So if you do still have people that or customers or clients that haven't accessed this type of funding, there are still dollars, and we do hope the businesses in our state are able to access this funding source. I wanted to speak just briefly to another program of the PPP, or another program of the SBA, and I don't have a slide on it. Let me pivot back to this. Actually, I'll go back to that. So I want to talk about the Shuttered Venue Grant Program, but I'll talk about it after this slide here. This will wrap up what we know right now in 2021. So this is just a breakdown from the SBA of the top 5 industries that have been granted SBA PPP loans. So we're not surprised here, right? Accommodation and food services making up 18%. Construction, likely delays in projects and the like, moving down the lines a little bit. So I want to just put that on there for your information. I wanted to cover, I don't have a slide on it, but the Shuttered Venue Grant Program. This was a new program out of the December 2020 stimulus program. This program included $15 billion in grants to shuttered venues to be administered by the SBA. And so those shuttered venues, we're thinking like museums, movie theaters, live venue operators, those businesses that really haven't been able to open to any degree, are eligible for these SVO grants. They're not loans, they're grants. They're equal to 45% of their gross earned revenue. with the maximum available amount for a single grant of $10 million. And $2 billion is reserved for eligible applications with up to, or applicants with up to 50 full-time employees. So again, some of those smaller, to set aside for some of those smaller venues. And I think one of the tricks here, and one of the issues we're having, challenges, I'm sure you've probably heard about this as well, is that if a business received a PPP loan in 2021, they are not eligible for the SBO grant. If they received a PPP loan in 2020, but not in 21, they can apply for the SBO grant. So that's a little bit tricky. What's also tricky is that the SBO grants are not open yet. So there's a very detailed Q&A on the SBA's website, FAQ on the SBA's website, a lot of detail on who's going to be eligible, how it works. That was recently updated last week. However, the program's not open yet. We don't know when it's going to be open, and PPP expires at 3/31. So I know we've heard some complaints from some lenders saying, well, I have a borrower who, if they can't get an SBO, they want to get a PPP, but we don't know yet if they're going to be able to get the SBO. So it's sort of putting the industry in a tricky, sticky situation. And in talking to my sources at the SBA, we just don't know when they're going to get that grant program up and ready for applications. So that is a source of continued frustration, I'd say. Before I pivot to loan growth and talking a little bit more about what's going on in our banks and credit unions, are there any questions on the PPP program or the rollout or DFI's role?
Roberta, a question came in, or more of a comment. Someone working on the PPP programs for a bank had mentioned that funds are getting out this second round, but it seems that SBA is taking longer to process and kind of push those through versus how quickly it happened the first round. Can you comment on that or aware of that?
Yes, yeah, I am aware of that. That is, another source of frustration. So they have added layers to their review process, apparently to mitigate fraud, and it is taking longer. That's, it's absolutely true. They know it. They've added, unfortunately made the process more cumbersome instead of less cumbersome. So we have heard of that. We understand the frustration. I'd say anybody involved in this program from the beginning, it's sort of been a constant source of frustration. That's why we really commend the institutions who this was thrown in your laps, right, to deploy the PPP program. The other SBA programs, the SBA administers those, but the lenders, specifically depository lenders out of the gate, were the ones that had to suffer for, with, really trying to deploy these loans with no rule book and no guidelines and no guidance. And it's evolved over time. It continues to evolve, but certainly there's been a lot of technical challenges. Okay, well, I'll move into some.
Oh, sorry, Roberta, there was one more in there. Does an employee biz owner need to make at least 100,000 K in 2020 to qualify? I'm not sure which program that was aimed at, but self-employed biz owner. Any thoughts on that?
I'm assuming they're talking about the PPP program.
Yeah. Is there a requirement that the self-employed business owner needs to make at least 100,000 to be able to get a PPP loan?
I don't believe so. There are upper limits on the amount you can, there's salary caps on what you can request as far as the loan or the funding, but I don't think there's a minimum. I've never heard of any minimum salary.
Okay, thank you.
Yeah, in fact, I've heard from some of these smaller non-depository lenders that are making PPP loans, they've made them to sole proprietors as small as $3,500. And so, yeah, I definitely don't think there's a minimum. Could be wrong. I could have missed a detail, but I don't think so.
Thank you.
Anything else, Steve?
Not yet.
Okay, terrific. We'll move right into some loan growth metrics. So this screen here, this includes all the banks headquartered in Washington. So Tim, I've got Washington Federal in here. It includes, the 3 national banks and the 38 state chartered banks headquartered in Washington. It doesn't include any of the banks or non-depositories. It also doesn't include credit unions that operate here in the state. So what you're seeing here are growth numbers. The first 2 bullets are overall loan growth. So this is 2019 to 2020, year end to year end. We have seen about 4% overall loan growth without the Paycheck Protection Program loans. And then approximately 12% growth with those Paycheck Protection loans. So one thing I, kind of this emphasizes is really our state headquartered banks made a very significant level of PPP loans. Of that 12 billion we deployed in Washington, approximately 8 billion of that came from these banks headquartered in the state. So it's a pretty big lift by those lenders, and we can see it in the growth numbers here. And of course, the vast majority of those loans we expect to go away. And so, that there is a kind of I didn't mention this on earnings, but there is, because those were, you're getting really an origination fee from those PPP loans. We do expect some good windfall in earnings from those origination fees as they continue to be recognized by the banks, because they have to be recognized over the life of the loan. So pretty significant numbers in PPP. Real estate related, these come from the call report codes. So this is all in real estate. This isn't commercial, residential broken out, unfortunately. And really the interesting thing is that this 3.2 includes unfunded balances. So, primarily construction loans that haven't been fully funded. The balance sheet number was actually 2.7% real estate growth from year end to year end. Similarly, on commercial, the 5.8% you're seeing here is the funded, or excuse me, the unfunded includes unfunded balances. And these are commercial non-real estate secured. So these are our true business lines. If you take a look at what's on the actual balance sheet of the institutions, it's actually a negative 8.4% growth. And then you add in these unfunded balances, you get to 5.8% growth. I don't really have a perfect sense for, why that is. My guess would be that the commercial borrowers are either not fully advancing on their lines, and or there's recently new year-end lines that have been approved and not yet funded. I don't have a good pulse for, why there's that discrepancy and that decline in balance sheet commercial loans, really outside of those PPP loans. Moving along here to credit unions. This is not apples to apples. So we're going off call report data because, we have to use publicly available data. We can't use any real exam data because that's confidential. So this is their member business lending growth. This is everything that's not consumer. And what we've seen on the credit union side is pretty tremendous growth. This 16.7% does not include the PPP loans that they made, which was around 325 million in the first round, or as of year end, 325 million. So they made quite a number of loans, but significantly less dollars than what we saw in the banks. And even though I don't oversee credit unions, I did talk to my counterpart over in our credit union group, and they really said right now that they're seeing the majority of this growth is coming in Eastern Washington. Specifically, the Spokane market is really hot. We're seeing some growth in construction and development, but primarily east of the mountains here. Steve, any questions at this point before I move into sort of what we're expecting and some of the factors as we look at commercial growth drivers?
I'm not sure it fits in perfectly here, but are you seeing anything in terms of bank acquisitions or mergers in the growth area?
We've seen a bit of a standstill in 2020. Certainly mergers has been the name of the game the last 10 years. In 2008, we had 91 state chartered banks. We have 31 state chartered banks, and our assets in the state have grown. So a lot of that came through mergers. A lot of our what I would call our larger banks are kind of serial, I call them serial acquirers. They've acquired a lot of smaller banks, and they've acquired banks in other states. So our banking assets have continued to grow overall year after year, largely through that consolidation. But we have seen a slowdown in that in 2020. I think probably banks were just on pause, trying to get through week to week what's coming at us next. So we haven't seen that. We do anticipate with the low earnings, you know, and that margin compression, we do anticipate there will be a few more institutions that, you know, decide the time is right to sell, and institutions that are looking to continue to grow. But 2020 was a very, very slow year for us with mergers.
Thank you.
You bet. So overall, impact to financial institutions has and will continue to be dependent on these stimulus payments. That's certainly been the case so far. The PPP program, all the other SBA programs, stimulus going to individuals, state level grants, all of these things make a difference. If these businesses are able to get help, what we've seen is that the financial institutions have been and continue to be very willing to work with them through this crisis. But there will be businesses, and there are businesses that have failed, and there will be people, and there are people who are filing for bankruptcy. And so we are concerned with some sort of wall of foreclosures when the various moratorium ends. Moratoriums, I'm certain that they serve a purpose, but you know, as we all know, it kind of kicks the actual issue down the road a little bit. And so we're not certain what will happen really in the state and across the nation as those various moratoriums end. There might be more stimulus from the current administration. That's an expectation. We'll see more stimulus to individuals, and that could really help. You know, that'll work for some people and it won't work for all, right? These programs won't work for everybody. So we will obviously and have been seeing some fallout and increased delinquencies. The issue of what will happen when the moratorium ends, this is something that the CFPB under the current administration is really keyed into. So it could be that they come out with, you know, some sort of rules around how institutions deal with those moratoriums ending as it relates to consumers. But we're yet to really see what that may look like. And again, there may be more stimulus from the current administration. So I think the industry as a whole, although none of us really like seeing our federal deficit balloon, you know, I do think a lot of people in our industry really feel that stimulus is going to help. It's going to help the financial institutions who at the end of the day are sort of stuck holding whatever losses result from these businesses that they have extended credit to. We get asked a lot about our outlook on CRE. We have very high commercial real estate asset concentrations in the state. And in the Western region in general. Again, it's not one size fits all as far as how, the outcome from commercial real estate, potential future valuations, current valuations. There's just so many moving factors here. There are obviously property types that are going to be more negatively impacted, property types that are more positively impacted. Remote workforce, there's the conversation of, well, what's going to happen when everybody moves to a remote workforce? At the same time, we're hearing from some businesses, well, we're not going to move to a remote workforce, but we are going to need more space for our employees so that people can work separate from each other. So how all of these factors interplay is still sort of yet to be seen, but in general, real estate values across the state have held. Some areas we're seeing those markets still booming, and we are seeing some property values become distressed, and people are taking advantage of that, opportunities for prime real estate purchases. We're seeing that in some markets as well. So it's really a mixed bag. Across the board, we don't have significant concerns over our banks who have large commercial real estate concentrations. those banks that have maybe a higher level of hospitality type loans, we're focused a little bit more on those institutions, but we're just not seeing a broad concern across the industry as far as commercial real estate valuation. A couple other factors that really, kind of drive growth, loan growth, is just this record low net interest margin and the excess liquidity. It really does intensify that search for higher yielding assets. And that will be a driver as well. Those institutions that have all that excess liquidity will be looking for opportunities to lend into the next year.
Well, we're there, Roberta. Questions come in.
Yeah.
On the multifamily property side, have you heard if Washington's statewide rent control initiative is gaining any traction in Olympia? And I guess an aside on that is DFI called in to testify on issues like that, or how does that work?
Yeah, so if it's coming from the governor's office, then they sometimes do ask for our technical expertise, but to be honest, they don't always, take our advice. They kind of do what they feel is they need to do. So we do provide technical, support to the governor's office on all the many moratoriums they have. We do often testify to the legislature on areas that impact, anything that really touches the financial institution. Specific to the rent control piece, we have not provided any testimony on that, nor to my knowledge have we been asked to give any, insight into that piece.
Thank you.
Yeah, it's tricky for sure, because certainly, my boss, Charlie Clark, he is part of the governor's cabinet. And it's just such a push and pull to try to help these businesses, but not put undue burdens on the lenders who, at the end of the day, what we've seen are really doing a tremendous job trying to work with these borrowers, right? I mean, especially 6 months ago, not many of your institutions really wanted to foreclose on a restaurant anyways, right? So, I mean, what are you going to do with it? So we're seeing banks continuing to work with borrowers, and, we're to the point now where most, especially on the commercial side, most businesses, even if they got a deferral out of the gate, they are making payments now, or they have restructured or modified their loan in such a way to weather the storm. And we do have businesses that are now seeking like a third round of deferrals, and the institutions are sort of deciding, okay, well, what do we do now? This is a borrower where we may have some losses, and at some point, we have shareholders and we have other factors to consider. So we're definitely to that point now. We're far enough down that the institutions know, okay, this group seems okay, this group maybe won't make it. Any other questions on that? Talk a little bit about cannabis banking, marijuana banking. So I'm happy you guys got a chance a few years back to meet with Rick. Rick was my boss at DFI, and we're still, really good friends and communicate frequently. So I have taken the baton on the marijuana banking and spent a lot of time talking about marijuana banking, although this last year, with all the distractions, I haven't been asked to speak on it as much, but we continue now 5 years down the road from when you met with Rick. We continue to have state charter banks and credit unions who are providing services to legally licensed marijuana businesses in the state. We have 5 banks, 5 credit unions who provide primarily deposit services. We do see some lending. Lending continues to be problematic. Obviously, it can't be secured with any of the product. So it has to be secured with other assets. Also, anything that involves some sort of government guarantee, SBA, sold in the secondary market, that comes into play with consumer loans to maybe individuals who work at these businesses or own these businesses. Anything sold in the secondary market is just a no-go as far as having proceeds from marijuana business. So banks have to be willing to portfolio the loans that they make in this space. That being said, so we feel like we do better in Washington than many states because we have a very tightly licensed and regulated industry by our Liquor and Cannabis Board. That provides us, a good line of communication between the financial institution and the Liquor and Cannabis Board, as far as communicating, how those businesses are doing. Are they following the laws? All of those types of things, so that the financial institution can do their required ESA reporting in this space. Just to highlight on the SAFE Act. So last Congress, 2020 Congress, the Safe Banking Act passed the House by a bipartisan vote of 321 to 103. And again, this creates a safe harbor for depository institutions to provide these banking services. Really, the big win if the SAFE Act is passed is that potentially these businesses will have what we say, access to the rails. They'll have an ability to use electronic transfers and not operate in so much cash. They'll have maybe direct access to Visa and or MasterCard if there's some sort of safe harbor. That's what really the hope is. So passed in the House, not passed in the Senate last year. At this time, the lead sponsor of the legislation, which is Congressman from Colorado, I'm gonna butcher his last name, Perlmutter. I cannot get that one out, but he is still reviewing the legislation and looking to make maybe some technical changes prior to reintroducing it. Some issues have surfaced in conversations with stakeholders, including concerns from hemp and CBD businesses. So with the legalization of industrial hemp in 2019, many of the medicinal marijuana businesses have now moved to industrial hemp. And so we've seen those industries, when you think they'd be working in parallel, we've seen them been a bit at odds, which is kind of interesting. But overall, we do suspect that in this 2-year session, in the next 2-year period of time, that this legislation will be brought forward in the House. And many predict that there is now support for it to pass this congressional session. So we do have hope that the Safe Banking Act may pass this congressional session. I don't think we'll see a lot of movement in this next 12-month period of time because obviously Congress is very focused on the pandemic. And so, we'll see. So I did want to cover just real quickly the MORE Act. So this is the Marijuana Opportunity Reinvestment and Expungement Act. So this is, also, kind of muddies the water a little bit. A lot of Democrats in both the House and the Senate are really taking a closer look at the MORE Act to see if whether or not they would prefer the MORE Act. So the MORE Act, what it does is it decriminalizes marijuana and eliminates criminal penalties for individuals who manufacture, distribute, or possess marijuana. And it doesn't seem like that MORE Act has a lot of bipartisan support. So if we see the Democrats really pushing for that MORE Act, it could kind of sidetrack the progress that they need on the SAFE Act. So it'll be interesting how that shakes out. We really don't think there's enough support in Congress for the MORE Act to pass at this point in time. So, and as you all know, we have continued to see states that we never thought would legalize marijuana. We've continued to see them legalize medicinal marijuana and other factors. South Dakota, Alabama, some of these states that are so conservative. And so, we do think that probably in this session, we'll see some movement on this. Let me pop back on camera here. With that, Steve, that's the end of my prepared remarks. I'm happy to answer any other questions that you or your group has.
Well, thank you. That was great. And just so everybody knows, Roberta has agreed to share slide deck. And so email Tim or I, and we'll get your email up to Mindy and we can get that out if that's something of interest. Great job. So 2 questions from me, kind of the, the ballpark ones of, what is your biggest looming concern that you see with state chartered banks? And then the second one is, what are you most hopeful to do in 2021?
Yeah, so I think the first one might actually be easier. Who knows what's going to happen in 2021, but I'll come up with something. As far as community banks, you know, we have 38 state chartered banks. We have not seen a de novo, brand new community bank in our state since July of 2009. So that's a long time ago now. And so that is a big concern. As you know, obviously financial services have changed. Banks are increasingly competing with other fintech options, but now we're seeing a lot more partnerships. We're seeing community banks start to partner with these fintechs. And these partnerships really work well together because what the banks have and depositories have is direct access to the payment system. So the ability to actually hold and settle deposits. At the end of the day, the fintechs, they don't have that. You know, they need some sort of correspondent bank to be able to actually take in and settle deposits. But they have, you know, really good new modern services available to consumers that consumers are needing. So we're seeing banks start to do these types of partnerships with fintechs. I think that will help. So that's my, you know, primary concern. We're not seeing new de novos. What kind of comes along with that is that you do have really, you know, communities that lack access to, you know, a community-based financial service provider. So we still have remote areas that have what we call maybe a banking desert. And, you know, you hope as these communities get better access to broadband and maybe adopt some of the newer online technologies that they won't suffer from the inability to access the markets. But that is a concern because that's what we see is that they don't have an ability to get the credit that they need to start the new business or whatever it may be. So, you know, those sort of banking deserts or deserts, you know, communities that don't have access to those services, that's a concern. Because as we've seen, even though there's less banks, they're a lot bigger. And when the banks get bigger, they get a little bit more complex and it gets a little bit harder to focus on that relationship-based lender, which is, you know, really paramount for the community banks to sort of preserve that aspect. What I'm looking forward to in 2021, I mean, we had so many trips on the books in 2020. We were going to go to Hawaii. We were going to go to Italy. You know, we did do some skiing in Montana, so that was nice. But the rest of it obviously got canceled with everybody else. So I'm looking forward to my kids not being home every day. Got 3 kids, 2 in middle school, 1 in elementary school. And you know, my husband's working at home too. So it's kind of a circus around here, but we're managing. So I'm looking forward to them going back to school and having an actual teacher and not wearing so many hats. I'll take that as my kind of number 1. And then maybe travel shortly thereafter.
Great. Open it up if you have a question. Either I don't see any new ones on the chat, but if you want to unmute yourself and ask a question, that would be great. We'll give that a second to percolate. And gosh, this is great. Thank you. And I think as part of the committee, we'll work on, maybe once every couple of years to get somebody in from DFI to kind of give us the lowdown, because I think your insights onto what's happening on the commercial lending piece is, really interesting. And I know that credit unions are playing a big role in commercial finance again. That's going to be a big piece.
Steve, I had a question for Roberta.
Sure.
I've been in the banking industry a long time, as a lot of us have, and I'm just curious, in the circles that you run in, are you seeing growth in the industry with younger professionals coming in and, either starting their careers or moving up and moving along?
Mm-hmm. Yeah, not so much. I think that is another thing. When there's less banks, there's less people to fill those sort of C-suites. And when we do our exams, we're working primarily with the C-suite. And I have not seen really a big influx of younger folks necessarily coming into that. We do focus a lot with our banks on, trying to make sure your boards are bringing in a good diverse mix of people. And that includes some of the, younger demographics. I think that'll be really helpful as we continue to see financial services evolve. But I'm not really seeing it unless we see it at our financial institutions. Although I spend my time with banks, I do go to the, credit union down the hill. And I do think that is a space that credit unions are maybe doing a little bit better job at, is getting a little bit more diversity in demographics and age and all sorts of things. At least it kind of feels that way. So I think that's something we still need a little bit more emphasis on. I think that would be helpful.
Great. Thanks, Tim. Anybody else? Well, it's 12:59, so we're ending a minute early. But thank you again, Roberta. That was a great presentation. And again, thank you all for being here. And we've got another event coming up in a couple of months. So watch your emails and keep up the good work, and get those PPP loans forgiven.
One more thing, if I can, I did include in the slide deck my email address. So I'm available and accessible to any of you should you have any questions. I may not have the answers, but I'm happy to work with you and track it down for you. So just let me know.
Perfect. Thank you so much.
Thank you, Roberta.
All right. Absolutely. Take care. Have a good rest of your day.
You bet. Thank you.
Thanks.
Bye.
Bye-bye.
Bye-bye.